Hi, Matt Justice here for Tackle Trading. We've been talking recently about the bear market, the correction. We do not yet know which one it is. We don't know if this is just a standard market correction like we have not seen in 3 years, where it comes down 10%, or whether or not this is something bigger than that. But when we're looking at the marketplace right now, I've been asked a ton recently, well, what do we do? What do we do? What do we do? What do we do? Well, it's not as simple as doing X, Y, or Z. There's many things you can do. You can trade inverted ETFs like SDS in the retirement accounts. You can, buy put options. You can go to a cash position. There's a few things that you can do in terms of preparing. But the only thing I know right now is that in the marketplace, you currently have more downside risk than you do upside potential. That doesn't mean it goes down, it just means you currently have more risk to the downside than you do the upside. And when we see those types of environments in the marketplace and in our 401ks, in our IRAs, in our individual accounts, we got to do something about it. It's like think about it like this. If you had a house and there was zero chance, you owned this home and there was zero chance of the house burning down and you were not forced to buy insurance, you would probably not spend the money for the insurance because there's literally zero chance of the house burning down at that moment in time. Well, that was kind of like the marketplace in 2013. The Fed was enthralled in their quantitative easing programs. We had a very standard trend, nothing but higher highs, higher lows. Yeah, the macro risk out there was certainly there, and we all knew we were coming to the end of a cycle. But at the same time, you were only in year four of that cycle, not year five and five and a half and whatnot. So we were looking at it and we're saying, okay, there's not a whole lot of risk right here. So why buy insurance? Let's just trade with the marketplace. But now we're at the end of a 5-year cycle. We're about 5.5 years into the bull market. You're starting to see slowing momentum. You're starting to see double bottoms. You're starting to see the Russell 2000 go down and, break support levels and form its picture perfect reversal and whatnot. And now our home is like tomorrow somebody comes up to you and they say, there is literally a 50% probability that your house burns down. 50% of the time it's not going to do that. It's going to just be there and it's going to appreciate over time. And the other 50% of the time tomorrow your house is literally going to burn down and I'm going to allow you to buy insurance today. And what would you do? Well, if there's a 50% chance that our house is going to burn down, we're probably going to go spend the money on the insurance. And that's kind of what I want to talk about very quickly. Let's say we had $100,000 in the marketplace, and it could be mutual funds, it could be market index ETFs, it could be long stock, it could be anything, but we're just always long. And that's what a lot of people who are in the markets they typically are. They're just long stock, long call, long this, long that. They buy, whatever the case might be. So they're just, let's say they're long. So I'm going to allocate $100,000 into an exchange trade fund, an ETF called the SPY. It's the spiders. And then we're going to look at kind of what the risk graph looks like. So give me 1 second. All right, so we're going to add a simulated trade, and we're going to buy 527 shares because that's right around the $100,000. So if you go to the risk profile here, you can see kind of what happens as the market goes down. As the market goes down, you show a loss. As the market goes up, you show a gain. You make 1-to-1 for the market. Goes up, you win. Goes down, you show a loss. Now let's say if you had the actual index that goes down to 180, which would be about a 20%, a 10% correction in the market. At 180, you're down only about $5,000. If it goes back up to 200, you're up about $5,000. So that's a 5% movement one way or the other. Let's say though we get a substantial market correction going down 20%. So if it goes down to 160, all of a sudden your loss is 15,920. And if you go all the way down, if you see that marketplace that actually does what a lot of people think it does and forms that bear market and goes down 50%, you're going to get about half your gains, and all of a sudden you're down $47,000 from currently, and down right around $53,000 from the very high that we saw a couple weeks ago in the marketplace. And that is substantial when we're talking about the long-term health of your mutual funds and of your money and growing your money and whatnot. And you can't let the house burn down. So what happens here, let's take this back up, this stock price back up to 180. What happens here, and as you can see those price slices move as I change the prices here, let's add another trade to it. And let's just buy an at the money put option. Okay, that's it. We're just going to buy an at the money put option. So as you can see, we have one at the money put option, each value of $934. It really doesn't do much to the risk wrap because we got to have more insurance than that. So as you can see, as I buy more and more and more insurance, all of a sudden you start to see the market start to go back up. So if the market goes up, we're not going to make as much, but we're certainly not going to lose very much as the market goes down, and that's kind of what insurance does. So now let's look at these price slices. Whereas we were losing $5,000 by doing absolutely nothing with the 10% correction down to 180, all of a sudden now you're only down $1,700. And if it goes up, you still make $2,700. Now let's take this back down to 160 again. That's your standard correction down to 10 to 20%. All of a sudden, instead of losing $15,000, now you've only lost $2,500 at that. And if the market does crash all the way down to 100, look at that. You actually show a gain in the marketplace if it actually goes down to 100. Now you might lose that up with a little bit of theta, but you see my point. With buying insurance, and in this example it wasn't that much. We're talking about a $100,000 portfolio and right around $5,500 in insurance. And all of a sudden we protect against the entire market crash to the point where you were losing $50,000, you're now showing basically break even in the marketplace. And that's what insurance allows you to do. And if you're new to the markets, new to trading, new to all of this, it's something we need to talk about in the coaches shows, but it's also something you should look to put into your portfolio as a little bit of a hedge, or what we call a stop gap. If we start to see these movements to the downside, it'll give you an opportunity and the time and the flexibility to learn how to trade while the market goes down. So definitely check out the Coaches Show on Tuesday. We're going to talk more about this live and in person with all of the coaches, how to hedge against risk in bear markets and whatnot. Check us out on the website at www.tackletrading.com. You can also check out the podcast on iTunes, Trading Justice podcast on iTunes. It's a 5-star award-winning podcast, and leave us a review on iTunes if you like it. Matt Justice for Tackle Trading. Have a great day.